Markets opened with relief today, Thursday, November the 13th. The US federal government reopened after its longest shutdown on record, with stocks and commodities reacting to the reset. At the same time, minerals matter. Copper has been added to the US critical minerals list, and a new congressional report accuses China of tampering with global critical minerals pricing. Well, look, joining us now is Mike McGlone of Bloomberg Intelligence. Mike, always a pleasure to chat to you.
Oh, it's my pleasure to be back on. Thank you.
Well, look, markets are opening with relief after Washington finally ended the shutdown. How significant is that for risk sentiment, Mike? And do you see this rally having legs beyond the next few sessions?
No, I don't. Unfortunately, the notable bear in the stock market, what I'm concerned about is like you mentioned, we're already on the 13th. This is the fourth day of the week, and gold is up almost 5% this week since we got that news. And the U.S. stock market's up about 1.5%. So I'm really concerned what this means. So it's a reality that the silly shutdown's done, but maybe now we're going to get the facts. First of all, it's going to be a major drag on economic activity, particularly for government contractors, which is basically 2-to-1 actual government people. We all know data is unemployment rates turning lower. Now it's going to take a while to get that data. The housing market's turning downward. Credit card delinquencies are higher. All the loan delinquencies are higher. And that's all despite the record-setting stock market. So to me, maybe gold's sniffing this out is the way I look at it. So I'm quite concerned about the whole space, which means in metals, typically the industrials, which means copper more and silver than gold. But right now, we are so overdue for a little bit of, I would say, just a little bit of alleviation of the complacency in the stock market. Volatilities are so low that I'm worried we're just going to get a little correction, and the question is how far.
All right, so gold and silver back to near record levels. I mean, is that purely a reaction to the Fed cut narrative and the return of government data, or are investors positioning for something deeper, perhaps, Mike, fiscal strain or currency displacement?
Well, I'm glad you went to gold silver, because I'm quite concerned about gold silver. As I pointed out, volatility is very high. Gold silver's back, the ratio's right back about 80. Now that's a key support level, and I'm just featuring a chart that shows the gold silver ratio overlaid with S&P 500 120-day volatility. Now about a month ago, I was using 60-day volatility. That's moved out to 90-day volatility. Now 120-day volatility is the lowest since basically 2021. So that it's a key level thing to remember about gold, silver, and gold versus any of the more industrial metals is for this ratio to stay near here, you need stock market volatility obviously to stay very low, because silver is much more of an industrial metal. So I'm afraid that's why I'm really concerned as we started out that we're just going to get a little reversion in stock market volatility. Basically, you need it to stay at an inordinate lower plateau. And I'm just pointing out it's probably going to normalize. So to me, that's obviously much better for gold than all the other precious metals, which means the key metal at risk would be copper, because you can overlay the S&P 500 with copper. And basically, since 2015, if you just lop off, 3 zeros off the S&P 500, it's the same per pound price as copper until the last 2 years. The stock market took off, and copper's kind of just trying to catch up.
Well, maybe it's a right place to come in here on that. I mean, copper's just been added to the U.S. critical minerals list. Does that mark a policy turning point for industrial metals, Mike? And could it pull in new capital into the sector?
Well, I do like where you went with that, Devin, because I was really it was my instrumental in getting the Bloomberg index team to create the Bloomberg All Metals Index almost a decade ago, because I see metals as the key place to go. I mean, that statement from this kind of reiterates the importance of metals and commodities versus you don't have that really for crude oil and grains, partly because we have an excess. We have to export them because we have a surplus in the United States of all those of liquid fuels and energy and natural gas and crude oil and corn and copper, but we definitely need things like copper. So I think the key thing is that's why I've kind of switched over this year to watching that U.S. price of copper rather than the one that trades on the LME, which is right now about just below $11,000 a ton near record, but that U.S. price right about $5. It's been stuck at $5, and so what it means is, I think it shows the importance of of the metals. But the problem I have with copper is it's bid for basically the wrong reasons this year. Obviously, we've had some significant supply constraints, which is basically more than double what we normally have. And usually those aren't as enduring. At the same time, we see that tilt towards deflation in China and the rest of the world facing those tariffs from the U.S. So I'm afraid what copper is going to do next year, basically it has Atlas's burden hanging on its shoulder right now. So if copper can get above 5 and get towards 6, that would mean basically a new high next year. But to me, to do that, first of all, you need the stock market to go up. Number one, prerequisite for everything now. It's very highly correlated. Unfortunately, sorry I have to say that, but they're just so high correlated. You need some kind of pickup in demand pull from China and maybe the rest of the world as they face these tariffs. So I'm really worried copper is going to do what it normally does and just revert back to 4. But you know what that means, Evan? It means more deflationary forces trickling down, because it would be on the back of crude oil. Crude oil is already down, almost 20% this year. And we see weakness in iron ore. We see weakness in Chinese government bond yields at 1.8%. And that's my fear, is if we just get a little back on the stock market, these dominoes tumble. And copper is the number one leading one. So I'm afraid copper is more likely to go back towards 4. Right now, as we speak, it's 5.13, then sustain anywhere near 6 next year.
Yeah, it's going to be interesting to watch. Listen, so just before I let you go, finally, that shutdown. Let's get back to that, Mike.
Yeah.
I mean, with the shutdown uncertainty gone and metals back in focus here, what's your read on where the next momentum lies? I mean, in precious safe havens or perhaps in the industrial metals recovery trade?
No, I'm completely in the former safe havens. Here's the problem I had. So I would like to point out, a number of years ago, during Trump administration 1.0, we had a love-hate relationship with the hottest asset class on the planet, which were cryptos. He hated them, I loved them. Now we switched over to he loves them, so now I hate them. So that asset class is showing major weakness. The Bloomberg Galaxy Crypto Index is down on the year. So that was a great way to get alpha. And then last year, I kind of tilted over to gold. Never expected this kind of alpha in gold. But when you get alpha in gold, that's an oxymoron. And gold outperforming everything is just quite concerning. So I think the next big trade is potentially risk off treasuries. Good, simple old U.S. treasuries, maybe to migrate where that 10-year note yield in the U.S. right now is about 4.1, to migrate where it is in China about 1.8. And there's one key catalyst for that, and there's just a little bit of backup in the U.S. stock market, which is way overdue. So that's my tilt. So if there's any time to be kind of risk adverse in markets, I think it's now.
Yeah, no, that's very interesting. Well, Mike McGlone of Bloomberg Intelligence, listen, always a pleasure to chat to you.
Thank you for having me.